In 2008, the global economy didn't just break, it was deliberately shattered. The collapse wasn't an accident, it was a controlled detonation. Behind the chaos of bank failures and panicked headlines was a system already crumbling under its own weight, waiting for the perfect excuse to rewrite the rules. Central banks, drowning in their own toxic promises, used the crisis to rescue not the public but themselves. They didn't stop the collapse, they needed it, because only in crisis could they justify the next stage of control. What if the institutions sworn to prevent catastrophe required catastrophe to evolve? This isn't a story of failure, it's the story of how central banks turned collapse into survival, and survival into power. In the early 2000s, the global economy appeared to be thriving. Low unemployment, steady growth, and booming asset markets painted the illusion of prosperity. But underneath that surface, central banks were silently confronting a structural nightmare of their own design. For decades, growth had been bought, not earned, purchased through waves of artificially suppressed interest rates, credit expansions, and increasingly complex financial engineering. Governments ran deficits with the assurance that central banks would absorb the consequences, and banks lent recklessly knowing their risk would be socialized in a crisis. This delicate system of mutual denial became a trap of its own success. By 2006, the debt-to-GDP ratios in developed nations were already reaching historical extremes, and private leverage, hidden inside housing markets, corporate bond pyramids, and shadow banking entities, was metastasizing. In theory, central banks were guardians of monetary stability, but in practice, they had become accomplices in a debt spiral they no longer controlled. Their balance sheets were tied to fragile instruments, mortgage-backed securities, sovereign debt with declining creditworthiness, and interest rate derivatives that only made sense in a world without volatility. The problem was scale. Every minor downturn now required exponentially larger interventions to maintain the illusion of stability. After the dot-com crash, the Federal Reserve slashed rates aggressively to reflate the system, unleashing a housing bubble as the next pillar of false prosperity. When housing prices soared and lending standards vanished, central banks had every opportunity to tighten, to intervene, to contain, but they didn't, because doing so would expose their dependence on debt-fueled growth and trigger a reckoning their policy tools weren't designed to handle. Instead, they issued calming statements, released carefully worded inflation targets, and pretended that market discipline still applied in a world where no major player was allowed to fail. Liquidity, not solvency, became the drug of choice. In Europe, the ECB was already quietly extending liquidity windows to undercapitalized banks in Spain and Italy. In the United States, the Federal Reserve had begun experimenting with repurchase agreements and interest rate adjustments that shielded the most vulnerable institutions while publicly insisting that fundamentals were sound. Beneath every economic indicator lay a deeper fragility, one built on the assumption that debt could grow forever, and that confidence alone could keep the machine running. But confidence is not a policy tool. It is a sentiment, and it breaks without warning. By mid-2007, warning signs were flashing in every corner of the global financial system. LIBOR spreads widened, interbank lending froze, and hedge funds began liquidating distressed assets to meet redemption demands. Central banks were watching the slow-motion implosion unfold, yet none took decisive preventive action, not because they were unaware, but because they were waiting for the perfect moment to abandon the illusion of normalcy, to claim emergency powers, and to rewrite the rules. The quiet crisis wasn't a blind spot. It was a standoff. The entire system had become too big to save incrementally. Only a total rupture could justify the next stage of central bank dominance. And they knew it. The illusion of prosperity that defined the early 2000s was propped up not by real productivity, but by invisible machinery humming behind closed financial doors. Machinery built on leverage so complex it blurred the line between asset and liability. Wall Street banks, hedge funds, and institutional players discovered a new religion: derivatives. Collateralized debt obligations, CDOs, credit default swaps, CDS, and synthetic exposures became the preferred instruments of profit, allowing the same dollar to be rehypothecated dozens of times and appear as safe collateral each time. A single mortgage issued to a subprime borrower in Nevada could be sliced, rated, insured, and resold across continents until it formed the basis of pension funds in Norway, and municipal portfolios in Japan. Off-balance sheet vehicles known as SIVs, structured investment vehicles, enabled banks to hide debt from their formal disclosures while maintaining access to the cash flows. Repo markets, operating in legal twilight, became the lifeblood of daily liquidity, with overnight loans backed by securities that themselves were backed by questionable mortgages. Financial institutions were no longer just lenders, they were shadow empires trading volatility itself. But this leverage was not a secret. Regulators knew, central banks knew. They monitored derivative exposures, swap spreads, and liquidity flows with the precision of astronomers tracking distant stars. Yet they did nothing, because the system had evolved into a high-stakes masquerade, intervened too early, and the fragile confidence propping up valuations would collapse. Do nothing, and the risk would metastasize. They chose the latter because the short-term optics of growth mattered more than the long-term danger of implosion. Even rating agencies played their part, bestowing A ratings on debt tranches that depended entirely on uninterrupted home price appreciation and zero default correlation, assumptions so unrealistic they would have been comical if not systemically fatal. When small hedge funds began collapsing under mortgage stress in 2007, these were not isolated events. They were pressure valves venting the excess steam from a boiler about to explode. But still, central banks stayed silent. They understood that the moment they acknowledged the scale of leverage infecting the system, they would be admitting their own impotence in regulating it. Containing it would require not just tighter oversight, but the dismantling of the very structures their monetary policy had encouraged. Low interest rates, endless liquidity, and a backstop promise that no institution of sufficient size would be allowed to fall. And so the illusion was maintained. Financial television broadcast record highs while banks quietly rotated risk into increasingly exotic instruments. Liquidity begets complacency, and complacency becomes systemic exposure. The global financial system in 2007 was not merely fragile. It was a hologram of stability resting on trillions of dollars in contingent liabilities that could cascade with a single spark. And the central banks, the alleged stewards of prudence, were not preparing to defuse the bomb. They were preparing to use the detonation as cover for something much larger, the transition from monetary guardians to systemic architects with unchecked authority. They didn't just tolerate shadow leverage, they depended on it. Because without it, the myth of stability would die. And with it, their mandate. Lehman Brothers was not simply a casualty of market miscalculation, it was a planned sacrifice at the altar of systemic transformation. By mid-2008, the financial system had already begun to seize. Bear Stearns had collapsed in March, rescued by a shotgun acquisition backed by Federal Reserve guarantees, and Fannie Mae and Freddie Mac were under government conservatorship by summer. The illusion of control was cracking, and policymakers knew they could no longer prop up the entire house of cards with backdoor interventions. The problem wasn't the collapse of confidence, it was that too much confidence still remained. Markets were still pretending this was a liquidity crisis, not a solvency one. Something bigger had to break. Lehman Brothers, the 158-year-old investment bank with deep roots in American finance, became the chosen ignition point. Unlike Bear Stearns, it would not be saved. On September 15, 2008, Lehman filed for bankruptcy with $639 billion as assets and $619 billion in liabilities, the largest corporate failure in U.S. history. The fallout was immediate and violent. Overnight funding markets froze, money market funds broke the buck, and interbank lending evaporated. But this shock was not a misstep. It was a detonation. The Federal Reserve, the Treasury, and their counterparts abroad had wargamed the collapse of a major institution and understood that a systemic crisis would grant them the political capital and legal flexibility to do what had previously been impossible. The Emergency Economic Stabilization Act, which would have never passed in normal times, now had an opening. Within weeks, central banks unleashed a barrage of tools. The Fed invoked Section 13(3) of the Federal Reserve Act, enabling it to lend to non-banks for the first time since the Great Depression. The ECB expanded collateral eligibility and began flooding the Eurozone with liquidity. The Bank of England coordinated dollar swaps with the Fed to prevent collapse in global dollar funding markets. Lehman's failure became the accelerant for a global financial firestorm that paradoxically provided cover for the most aggressive consolidation of monetary power in modern history. What followed was not disorder, but a rapid-fire sequence of interventions prepared in advance and deployed under the cover of emergency. AIG was rescued with $182 billion in taxpayer support. TARP was passed to inject $700 billion into financial institutions. Central banks began direct asset purchases, not as policy experiments, but as premeditated paradigm shifts. In the aftermath, the narrative was set. Lehman's collapse was the cost of inaction, and everything that followed, the bailouts, the liquidity traps, the debt monetization, was necessary to save the world. But what had actually been saved was not the economy. It was the credibility and future dominance of central banks that had no other path forward. By letting Lehman burn, they lit the fuse on a chain of events designed to bury the old limits of monetary policy and replace them with unchecked power cloaked in the language of necessity. The world didn't stumble into financial chaos. It was led there, carefully, deliberately, and with the full knowledge that once the system cracked, the rules could be rewritten by those already holding the pen. In the smoldering aftermath of Lehman's collapse, central banks wasted no time seizing the opportunity the crisis provided. Within days, the Federal Reserve slashed interest rates towards zero, initiated emergency liquidity facilities, and began absorbing toxic assets from balance sheets that had long been doomed. But this was not improvisation. It was the execution of a contingency playbook quietly assembled over years of watching the system drift toward unmanageable complexity. The term auction facility, the commercial paper funding facility, and the primary dealer credit facility were rolled out in rapid succession, allowing banks to offload their worst liabilities in exchange for pristine liquidity. The Federal Reserve's balance sheet swelled from under $900 billion in 2007 to over $2 trillion by the end of 2008, a transformation that redefined its very purpose. Across the Atlantic, the European Central Bank followed suit, opening the liquidity spigots to insolvent Eurozone banks, while abandoning collateral quality standards under the euphemism of temporary flexibility. In Japan, the Bank of Japan expanded its purchases of corporate paper and government bonds, reinforcing its role not just as a lender of last resort, but as a permanent market participant. These institutions had once existed to ensure monetary stability. Now they were buyers of last resort, credit allocation engines, and covert underwriters of sovereign debt. Toxic mortgage-backed securities, once considered financial waste, were now held at full face value on central bank books. Failing institutions were kept alive through rolling credit facilities that prevented resolution but guaranteed dependence. What emerged was a new regime, one in which free markets only existed when asset prices were rising. The moral hazard was not a consequence of panic. It was the objective. By demonstrating their willingness to purchase anything at any price from any institution deemed critical, central banks removed the last shred of risk discipline from the system. And with each intervention, their political independence transformed into something more sinister, unaccountable authority under the guise of emergency. The collapse had not been prevented, it had been nationalized. The risk had not been reduced. It had been transferred to balance sheets backed by taxpayers, voters, and future generations. What began as crisis response quickly calcified into doctrine. Quantitative easing became not just a tool, but the default policy engine. Market prices were no longer set by supply and demand, but by anticipated central bank intervention. The institutions once tasked with managing inflation now managed perception of stability, of solvency, of legitimacy. And all of it justified by the single premise that collapse would have been worse. What they had really accomplished was unprecedented, transforming temporary emergency measures into permanent mechanisms of market control. In a matter of months, the guardians of monetary order had become the architects of economic reality, wielding tools with no precedent and facing no oversight. The crisis didn't weaken central banks, it crowned them. And the public, battered by fear and disoriented by complexity, accepted the transformation without realizing that the very institutions claiming to save the world were saving themselves by becoming the system itself. While politicians and central bankers delivered speeches promising stability and recovery, The reality on the ground told a very different story. The trillion-dollar bailouts announced in emergency press conferences were framed as heroic efforts to save the economy from collapse, but they flowed directly into the vaults of the very institutions whose reckless behavior had engineered the disaster. Major banks, freshly gutted by toxic mortgage portfolios and derivative bets that had turned lethal, received direct capital injections from public funds with minimal oversight. AIG, whose exposure to credit default swaps threatened to unravel the global financial web, was handed $182 billion, much of which went straight through to counterparties like Goldman Sachs at full dollar value. Meanwhile, millions of American homeowners were losing their jobs, defaulting on mortgages, and watching their life savings vanish in stock portfolios propped up by stimulus they could never access. In neighborhoods across the country, foreclosure signs bloomed like weeds, while on Wall Street, executive bonuses resumed barely a year after the crash, rationalized by retention needs and contractual obligations. Unemployment soared to levels not seen in decades, but the Dow Jones surged back within months, fueled by asset purchases and zero-interest liquidity that rewarded capital over labor. The rescue was never intended for the public. It was engineered to preserve a financial order that had privatized gains and now sought to socialize losses. Programs like the Troubled Asset Relief Program, TARP, and quantitative easing were sold as necessary to avoid systemic failure. But they effectively created a two-tier recovery. Banks were made whole, stock prices were stabilized, and bondholders were shielded. In contrast, ordinary citizens were offered piecemeal solutions: short-term mortgage forbearance, small-scale stimulus checks, and job retraining programs for industries that would never return. The wealth gap didn't just widen, it exploded. Between 2009 and 2012, the top 1% captured 95% of all income gains, while median household wealth declined. Central banks, under the guise of restoring economic equilibrium, became the primary driver of asset inflation that benefited those who already owned real estate, equities, and capital-intensive businesses. This wasn't a bailout of the economy. It was a transfer of crisis risk into long-term public debt and a reshuffling of wealth from the bottom up. Every dollar printed by the Federal Reserve to purchase mortgage-backed securities propped up asset prices that the average worker could no longer afford. Every central bank liquidity injection raised the floor under Wall Street while lowering the ceiling for everyone else. The public was told they had been saved from catastrophe, but what they actually inherited was a future mortgage to preserve a financial system whose core function had shifted from allocating capital to extracting it. The 2008 crash wasn't just a market event, it was a pivot point where crisis management became a mechanism for permanent wealth consolidation. And the divide between those who benefited from central bank power and those who paid its price became the defining economic reality of the 21st century. In the wake of the 2008 collapse, central banks did not retreat once the fires were extinguished. They entrenched themselves as the permanent architects of economic reality. What began as emergency intervention hardened into systemic control, and the unthinkable tools deployed during the crash became the standard operating procedure of a new financial era. Quantitative easing, once framed as a temporary response to extraordinary distress, never ended. It evolved into a rolling, open-ended mechanism for managing asset prices and liquidity flows. The Federal Reserve began purchasing not just treasuries but mortgage-backed securities in staggering volumes, directly influencing the housing market from the central bank's balance sheet. In Japan, the Bank of Japan pushed further, buying exchange-traded funds and corporate bonds, transforming itself from a stabilizer into an equity stakeholder in the private sector. By 2015, the ECB joined the chorus with its own asset purchase program, acquiring sovereign and corporate debt while pushing interest rates into negative territory, an idea once considered economic heresy. But it was not just the scale of intervention that marked the birth of central bank absolutism, it was the scope and permanence. Central banks now dictated the price of money, the value of government debt, the volatility of markets, and the risk tolerance of entire economies. Market participants no longer speculated on economic fundamentals. They speculated on central bank behavior. The phrase, "don't fight the Fed," morphed from investor folklore into systemic law. Independence from political influence, once considered the ethical cornerstone of central banking, became the shield that protected these institutions from any form of democratic accountability. Monetary decisions affecting trillions in wealth and income distribution were now made by unelected officials operating behind closed doors, insulated from legislative scrutiny and public debate. Central bank press conferences replaced budget votes as the events that moved markets. The public was told that technocratic expertise had replaced ideological conflict, but what actually emerged was a new form of monetary governance, one with near absolute authority and no direct constituency. With each passing year, the line between state and central bank blurred. Fiscal deficits were implicitly monetized through relentless bond purchases. Market corrections were preemptively softened by liquidity injections. Entire sectors became dependent on the assumption that central banks would not allow failure. The idea of normalization, returning to a world of positive interest rates and limited intervention, became a myth repeated by officials but never pursued in practice. Every dip in the market was treated as a threat to financial stability, justifying further expansion of balance sheets that by 2020 had ballooned into the tens of trillions. The institutions that had once operated in the background became omnipresent forces guiding investment, consumption, and even employment. Central banks were no longer referees, they had become players, coaches, and stadium owners. And in their ascent to untouchable prominence, they revealed a deeper truth. The global economy was no longer driven by the interplay of risk and reward, supply and demand, but by the decisions of a few unelected officials whose tools were limitless and whose accountability had quietly vanished. Throughout the post-crisis decade, central banks around the world choreographed what appeared to be a unified global recovery. But beneath the polished language of cooperation lay a fragile dependency web held together by synthetic liquidity and blind trust in continued stimulus. The Federal Reserve led the charge with expansive dollar swap lines to foreign central banks, ensuring that dollar funding would remain available globally even as credit markets seized and interbank trust evaporated. The European Central Bank, the Bank of Japan, and the Bank of England followed in lockstep, lowering rates in tandem, expanding asset purchases, and quietly coordinating policies through Basel, Jackson Hole, and G20 meetings. What was presented as international solidarity was, in practice, a silent agreement to suppress volatility and delay reckoning. National economies had diverging fundamentals. Europe was mired in structural stagnation, Japan faced demographic collapse, and the U.S. was running trillion-dollar deficits, but their monetary responses became indistinguishable. Interest rates hovered near zero globally, and central bank balance sheets swelled in parallel, creating the illusion of synchronized growth. Markets rallied in unison, credit spreads narrowed, and volatility vanished, not because underlying risks had disappeared, but because the institutions meant to monitor risk had absorbed it instead. Monetary policy became the primary engine of global economic narrative, while actual productivity gains, infrastructure investment, and real wage growth remained anemic or non-existent. Emerging markets, flush with speculative capital-seeking yield in a zero-rate world, borrowed heavily in dollars, making themselves dependent on continued dollar liquidity controlled by the U.S. Fed. Meanwhile, developed markets built towering asset bubbles in equities and housing, mistaking central bank distortion for sustainable expansion. Even when signs of stress reemerged, like the 2013 taper tantrum or China's 2015 devaluation scare, the response was always the same: renewed stimulus, reinforced coordination, and ritualistic reassurances that tools remained. The system had no redundancy, no capacity for retreat, only a perpetual motion of intervention. International coordination was not evidence of strength, it was a sign of shared vulnerability. Each central bank relied on the others to suppress fear, stabilize capital flows, and prop up the illusion that the post-2008 world had recovered on its own terms. But what they built was not a recovery, it was a monetary mirage. The shared toolkit of low rates, bond purchases, and forward guidance masked deep institutional fragility and fiscal dependence. Globalization of policy meant the globalization of risk. When one major central bank failed, they all would. And so the entire post-crisis decade became a high-wire act without a net, where the world's economic trajectory was no longer determined by innovation, productivity, or reform, but by the seamless choreography of central bankers who couldn't afford to let the music stop. They didn't just manage the system, they became it, and the illusion they sustained grew larger with every synchronized breath they took. By the time the global economy entered the 2010s, what had been introduced as a set of temporary crisis measures had quietly ossified into permanent structure. Central banks that once promised to unwind their interventions as conditions normalized found themselves unable or unwilling to reverse course. Zero interest rate policies, ZIRP, became standard practice, not because they fostered growth, but because the system had become so debt-dependent that even modest rate hikes threatened collapse. The Federal Reserve, the European Central Bank, and the Bank of Japan all anchored policy around the assumption that cheap money must continue indefinitely to support inflated asset prices and bloated public debt. Governments across the developed world responded with glee. With interest costs artificially suppressed, deficit spending lost its stigma. Fiscal responsibility gave way to opportunistic expansion. Infrastructure projects, social programs, and even tax cuts were financed through bonds that were immediately absorbed by central banks and secondary markets, ensuring liquidity, suppressing yields, and erasing the line between monetary and fiscal policy. Though never formally acknowledged, deficit monetization had arrived. Sovereigns issued paper and central banks bought it, and every market actor understood the code. Assets would be protected, volatility suppressed, and downside risk absorbed by institutions too powerful to fail. But this arrangement birthed a doctrine far more insidious than ZIRP or QE. What emerged was the doctrine of the permanent emergency. Every economic slowdown, every market dip, every geopolitical tremor became a justification for renewed intervention. Stimulus was no longer a reaction to crisis. It was the precondition for stability itself. Markets, once volatile by nature, became conditioned to expect instant rescue. The so-called Fed put evolved into an unspoken guarantee. No significant downturn would be allowed to persist without central bank response. Political leaders, too, adapted. Fiscal reform was deferred, painful structural adjustments ignored, and hard policy decisions postponed indefinitely, all under the assumption that central banks would remain the ultimate backstop. By the mid-2010s, this dependency was complete. Interest rates remained near or below zero for over a decade, and negative rates were implemented in the Eurozone and Japan, a concept so radical it defied centuries of financial logic. Yet it became the norm. Central bank balance sheets grew to staggering proportions, with the Federal Reserve, ECB, and BOJ collectively holding over $20 trillion in assets by 2020. Meanwhile, the real economy stagnated, productivity gains slowed, wage growth lagged inflation, and inequality exploded. The benefits of monetary expansion flowed upward, while the structural weaknesses underneath, zombie companies, misallocated capital, and bloated sovereign debt, festered unaddressed. What had begun as a firefighting effort in 2008 had metastasized into a new regime of crisis governance. And in this regime, the emergency never ended. It became the oxygen of modern finance. The central banks, once bound by mandates and limited tools, now ruled over a monetary landscape of their own making. Their power had no off switch because the system they saved could no longer survive without them. The legacy of 2008 is not a reformed system, it is an empowered regime. The financial architecture that failed spectacularly did not get dismantled. It was absorbed, normalized, and institutionalized under the control of the very central banks that presided over its collapse. Regulatory reforms were cosmetic, capital buffers increased on paper, and oversight committees multiplied. But the core dynamic remained untouched. Central banks would intervene at every sign of instability, and markets would front-run those interventions with impunity. The post-crisis world didn't restrain the financial sector. It merged it with the state. Central banks became the fulcrum of economic power, no longer bound by traditional mandates like price stability or full employment, but operating under the expansive new justification of systemic stability, a concept so elastic it permitted virtually any action in any market at any time. And while the public was distracted by the political theater of reform, these institutions cemented their role as the central nervous system of global finance. Tools that were once considered extraordinary, quantitative easing, emergency lending facilities, balance sheet expansion into corporate debt and equities became permanent fixtures, not because they solved underlying problems, but because the system now required them for survival. This was not a bug, it was the design. The central banks, having inherited a broken system, chose not to fix it, but to redefine the terms of control. They became the lenders, the buyers, the backstops, and ultimately, the final arbiters of value. Markets adapted by becoming dependent. Corporations adapted by issuing endless debt to buy back shares, confident that interest rates would never rise meaningfully again. Governments adapted by abandoning fiscal discipline, secure in the knowledge that central banks would monetize deficits indefinitely. The cycle completed itself. What began as crisis response became systemic, doctrine, and now a darker truth emerges. This wasn't just about saving the economy, it was about saving the institutions of monetary power from their own irrelevance. The crisis that should have threatened their legitimacy became the gateway to their consolidation. In securing their survival, they ensured that the next crisis, whether caused by debt, liquidity, geopolitics, or contagion, will not require debate about central bank intervention. It will be assumed, expected, demanded. But this time, the tools will be more powerful, the reach more invasive, and the oversight even more absent. Central bank digital currencies are being tested, algorithmic liquidity controls are being modeled, coordinated monetary fiscal fusion is being piloted. The next collapse will not be met with hesitation, it will be met with pre-programmed authority. And that authority will not just support markets, it will govern them. The real legacy of 2008 is not that the system broke, it's that the guardians of that system used the crisis to become its undisputed rulers. They weren't saving the world, they were saving their place at the top of it.